When you own a stock, an earnings event can be very scary because you don't know what's going to happen with the implied volatility of the stock. I have a solution for this fear. Let me explain. Most people fear the potential loss in the actual stock value, but this solution actually allows you to buy 100 shares of a stock you're comfortable buying it at. This is called selling a cash secured put. Basically, what you're doing is you're agreeing to buy 100 shares of a stock if it reaches a certain price you're comfortable with. And the best part is you get paid to do this. I look at earnings reports on my favorite stocks as a great opportunity to basically be able to take ownership of shares at a low cost if it reaches that cost. If it doesn't reach that cost, I'm not forced to buy those shares. The implied volatility during these earnings events increases substantially, and that's exactly why you can make so much money as an option seller by agreeing to buy shares at a low cost, aka selling a cash secured put. Let me run through the best scenario that can happen and the worst scenario that can happen when you agree to enter this contract. Best thing that can happen is you don't get assigned on the shares, you keep the premium you collected at the beginning of the trade, and you're able to enter new trades after the expiration period. Worst case is, which is not even that bad, you take ownership of 100 shares of the stock at the price you agreed upon, you still keep your premium you collected at the beginning of the trade, and now you're able to sell covered call options the next week. These premiums are substantially larger during these earnings events because the implied move of the stock is much larger because of the earnings catalyst. In most earnings reports, the stock either goes up a dramatic amount or goes down dramatic amount during the earnings event based on the results. Let's take a look at a specific example on Tesla this week. They do release earnings later this week. So here you can see Tesla's trading right around $445. And basically what we're going to do is we're going to go to trade options in order to sell a cash secured put. So what we're going to do is make sure that sell put is selected at the top of the screen here. We're going to make sure that October 24th is selected as our expiration date to capture this earnings event. We're going to go to the current market price on the options chain, and we're going to scroll down to find a price we're comfortable owning Tesla shares at. So I'm going to choose this $390 strike price here. The likelihood of this stock reaching $390 is about 6% based on the delta value. So here we're going to choose this option here. We collect over $120 for agreeing to buy Tesla at $390 per share. If it doesn't reach $390 per share, we're able to collect that $120 pretty much risk-free and get our capital back at the end of the trade. This process is exactly how I'm able to collect premium on a weekly basis from agreeing to buy 100 shares at a low cost. Sometimes I'm assigned on those shares, sometimes I'm not. That's the beauty of the wheel strategy because you can turn around and start selling covered call options if you are assigned. If you guys do want to learn more about exactly how you can implement this strategy on your own, comment the word guide down below and I'll send you a free guide on how to get started on your own.